The REIT signals that exist and the ability to play in both public and private can create significant value. And I think large investors should be very attuned to those forces and take advantage of them as best as they can.
Hello and welcome to the REIT Report. I'm your host, Sarah Borkson-Keto. My guest today is Cedrik Lachance, Director of Research at Green Street. Cedrik has a global team of more than 60 analysts in commercial real estate, which makes him particularly well positioned to offer insight into how the REIT and commercial real estate markets are performing today. Cedrik, great to have you on the podcast.
Thank you, Sarah.
So I wanted to start by asking you to describe the operating environment for US-listed REITs as we round out 2024 and look ahead to 2025.
Yes, it's generally positive. When you look at the economy, we're probably going to see GDP of 2% next year. Job creation is probably in the 100 to 150,000 per month. So that's not great, but it's not bad. And income growth, especially disposable income growth, could be on a decent path, potentially a little bit better than what we expected some months ago. And then when you look at where we're at from a net worth perspective, given where the S&P 500 is, I think there's also some pent-up ability to spend that is being generated, which is going to be positive for high-quality real estate, which is often what the REITs own, of course.
What do you expect to be among the key priorities for the sector next year?
Well, in some ways, it should always be the same. REITs should always be focusing on growing income from their real estate through their operational excellence. And then it becomes about proper balance sheet management and then taking a reasonable amount of risk around allocating capital, in particular around development. And what becomes the real differentiating factor for REITs is how they allocate capital. And I say that because REITs tend to be very good operationally. The vast majority of REITs that we cover are the cream of the crop when it comes to operating a real estate and really harvesting as much NOI growth as should be possible from their portfolio. So the difference then becomes how do they allocate capital? And it's really a question of how do they follow their cost of capital signal, which from our perspective is taking advantage of what you see in the public market. So what's your cost capital, obviously, per the public market, and then using that wisely in how to either grow the portfolio or shrink the portfolio. We wrote about that recently. We had a Word on the Beach that was called Make Hay. And our perspective on it is with the REIT market bestowing some pretty meaningful premiums in some sectors, we expect to see a fairly aggressive deployment of capital from companies in the data center space and healthcare, and as well as storage, and to some extent in retail as well, where many companies now trade at premiums to NAV. And then in a change versus recent past, you even see the office business where some companies trade at premiums to NAV, and I think that's going to influence how they allocate capital. The flip side from that is you have a number of sectors that trade at discounts. I think about cold storage or hotels, life science business, single-family rental. And I think it's a series of sectors where we should see companies shrink rather than grow.
In terms of sectors, can you point out which ones that Green Street has the most confidence in terms of substantial growth potential for 2025?
So from a fundamentals perspective, so if you think about where will rents grow the most, market rents grow the most, and to some extent occupancy, we're very much in many cases at levels of occupancy that are difficult to beat on a year-over-year basis. So where we see the most rent growth potential is obviously in data centers. That story has been well told, but it remains an area where we think there's meaningful upside. The senior housing business is in the midst of a continued important recovery. So there you're going to see some occupancy gains. And pricing power is meaningful in many cases. So you're going to see rents grow in a positive way for the sector. And I say that there's meaningful pricing power because where we're at from a net worth perspective suggests that obviously tenants in senior housing will have the ability to pay the rent. We're seeing also prospects for very good rebounds in rents and storage in 2025 and beyond. And then in sectors like single-family rental, manufactured homes, malls and strips, we should continue to see decent market rent growth. Now, those are absolute numbers. If you think about where the momentum is, where we're starting to see surprises. Retail has been, to me, at the top of the list. So for the last year plus, we continue to see retail do a little bit better than expected on pushing rents. And that's really a function of having no supply in the machine and really retailers that are becoming more and more willing, of course, to expand and starting to pay a little bit better rents. And then the big surprise, I think, for many is you're starting to see momentum in office. And you should most likely expect some positive surprises from, again, a rent and occupancy perspective in office, admittedly starting from very low levels, but you should see some positive surprises in office next year.
Great. And can you talk a little bit about what you're seeing with respect to the public-private real estate valuation gap and what that means for public REITs going forward?
So in many ways, that's our bread and butter to think about that. To us, real estate is a big part of the capital markets. And so it allows us to look at real estate versus investment alternatives. And where we like to focus the most is on corporate bonds, both investment grade and non-investment grade corporate bonds. When you compare where we're at on expected real estate returns versus both investment grade and non-investment grade corporate bond, you'd say real estate's about fairly priced. If you are more of a risk-on type individual and focusing primarily on non-investment grade relationship to real estate, you'd see a little bit more juice in terms of real estate asset values going up. But overall, we're about where we need to be versus where borrowing costs are. The other interesting indicator to us, of course, of real estate is comparing the public and the private. And the public market today trades at about the 5 or 6% premium to gross asset value. So make that 8-9% premium to NAV. And at that level of signal, about 3/4 of the time, it suggests that private asset value should be going up over the next 6 to 12 months. So it's a fairly strong signal that suggests positive and near-term growth for real estate asset values. Yeah, one more point on that. When I talk about asset values, I talk about the Green Street views on private asset values. So we see a lot of reported values by pension funds and others that are based on the valuation industry that often looks backwards by at least a year. The values that we use are trying to be as real time as possible through conversations with the marketplace. And so, from our perspective, asset values in the real estate space are up about 5% year to date and are down a little less than 20% from 2022. So, it's important to establish those markers as to where we're at versus where others might be.
And Cedrik, are there certain questions or themes relating to the outcome of the recent US election that you hear circulating in the REIT industry today?
Yeah, so first, I think we spend perhaps too much time wondering about this because there's a certain element of discussing things that we really don't know what's going to happen. So at Green Street, we try to focus on what we can control, and what we're good at is the real estate element. It's not whereas speculation on rates or speculation on what an administration will do. Now, there's no doubt that with the Republican president, Republican House, and the Republican Senate, there is more ability to enact an agenda. But how that really takes place is still unclear. There's expectation, of course, for some level of changes on trade policies. We'll see if it has meaningful impact on industrial, for instance. It's not clear to me that it will be the case. There's certainly odds on that you'll see fewer regulations, and so that could be in many ways beneficial. I think generally you see a business environment or businesses broadly that exude more confidence. And then you have questions, of course, about immigration and the pool of labor supply you're going to have over time. And there certainly could be some disruption to the growth pace of the labor force. But while that can have a negative cost impact or an inflationary cost impact to lower skilled labor, it could also reduce supply growth.
REIT. And Green Street recently issued research looking at 20 years of REIT IPOs. Where do you see the needle settling between headwinds and tailwinds for the future of REIT IPOs?
Yeah, as you said, we wrote about the last 20 years of IPOs, and a couple of key takeaways here. First is IPOs tend to take place in sectors that trade at decent premiums to gross asset value. In fact, that premium tends to be around 6 to 7%, which is basically where we're at on average for the REIT industry today. The IPOs tend to take place again in sectors that trade at bigger premiums, in an environment in which the REIT industry generally trades a little bit above NAV. So a tailwind today is that we are in an environment where we trade at decent sized premiums to gross asset value. And you have a number of sectors, if you think about data centers and healthcare in particular, that trade at good premiums to NAV, which suggests that IPO activity would make sense in these businesses. It would also make sense in other businesses, such as the retail space, for instance, or the storage business. So you're starting to see more areas where it would make sense. The flip side is there hasn't been a lot of transaction activity in the last 2-3 years broadly in the real estate market. And so the wheels of acquisitions and dispositions are moving slowly, which obviously can reduce the pace at which these realizations take place and therefore the pace at which IPOs would come to form. The other challenge from an IPO perspective is that many private equity outfits will seek to have long-term capital now and trying to keep, of course, assets in-house in many ways. So listing is no longer the dominant way to sell a large chunk of assets or a particular business. And many private equity businesses will tend to maintain their platforms on the private side, and therefore that reduces the odds of IPOs.
And turning to Europe now, how do investment trends there compare to what you're seeing in the US, broadly speaking?
I think so. From an economic perspective, certainly the pace of economic growth is a lot slower in Europe, and there are perhaps a lot more question marks as to the ability to move the economies forward. But when you think of what's happening to good quality real estate, there is nonetheless a very interesting path forward for fundamentals in a variety of businesses. We see a lot of momentum, for instance, in the retail space and in the residential space. So residential in Europe tends to be more regulated, and there is a fairly wide gap between demand for space and the supply that's been coming in. As a result, there's an ability to push rent that's real in the residential space in Europe. You're seeing the rise of office a little bit like in the US. So you should see some rent momentum coming up in office. And then if you think about absolute NOI growth for the REITs themselves, the industrial business should do very well. The tower business should be doing particularly well. You will see also self-storage most likely being one of the better businesses from an NOI growth perspective in Europe.
Right. And finally, Cedrik, you touched on lots of different points. Anything that you haven't already mentioned that you think it's important to keep in mind when assessing the REIT landscape in the coming year?
Yeah, I think, look, REITs are a tremendous way to invest in real estate. It can be a great way to complement a private portfolio with sectors that are more difficult to access on the private side. REITs can be a fantastic way to arbitrage values between the public and the private market. So there are ways to buy at big discounts to NAV in the public market or vice versa, using the private market when the public is at a big premium to NAV, because when the public's at a big premium to NAV, generally the private market will follow in that sector. And so the REIT signals that exist and the ability to play in both public and private can create significant value. And I think large investors should be very attuned to those forces and take advantage of them as best as they can.
Cedrik, thanks so much for your time today.
It was a pleasure. Thanks, Sarah.
And to our listeners, if you enjoyed this episode, please subscribe on your favorite podcast platform.